House prices rise 3% yearly, mortgage impacts shockingly high. You find a house for $400,000, but due to an annual inflation rate of 3%, its cost increases by that percentage each year. That might seem small initially, but over 10 years the price would grow significantly. Using the formula for compound interest, the future value of your home can be calculated as follows. $400,000 times 1 plus 0.03 $539,782. Inflation isn't just making everyday items like coffee more expensive. It's quietly eroding the purchasing power of your savings and potentially doubling the price of big-ticket items such as homes over longer periods. Inflation impacts mortgages by reducing your purchasing power over time. Let's look at how this works with real numbers. Suppose you buy a home for $400,000 with a 30-year fixed mortgage at an interest rate of 5%. Your monthly payment would be approximately $2,178. Now imagine that inflation is running at 3% annually. Over 10 years, the cumulative effect of inflation would increase the house price by more than $40,000 for every $100,000 in today's dollars. That means if you hadn't bought it right away and waited a decade, a home that costs $100,000 today would cost approximately $134,392 due to inflation alone. But what about your mortgage payments? Even if you're paying the same amount every month, rising prices due to inflation mean that your purchasing power is decreasing. While your fixed monthly payment remains constant, it can buy fewer goods and services each year as inflation erodes its real value. Let's break this down step by step. First, understand what a mortgage does. It gives you money now to buy something expensive like a house. You agree to pay back that loan with interest over many years. However, if prices go up due to inflation, the real value of your monthly payments decreases because each payment buys less in terms of goods and services than when you took out the mortgage. Here is how this impacts you. 1. The bank gives you a mortgage, typically around $400,000 to buy a house. 2. You agree to pay back the loan plus interest over 360 months, 30 years. 3. Inflation means that goods and services cost more each year, reducing the purchasing power of your future income, but also potentially decreasing the real value of your mortgage payments if your income grows at least as fast as inflation. So let's talk numbers. If you're paying $2,178 per month for your mortgage today, in 10 years at a steady inflation rate of 3%, those payments will only have about half the purchasing power they do now. That's because prices generally increase by approximately 34% over 10 years due to inflation, not double. So what used to buy you groceries and gas might cover less of your daily expenses, but it doesn't mean that your mortgage payment will consume all your income for necessities like food and fuel. This is why understanding inflation is crucial when considering a mortgage. While your monthly mortgage payment remains fixed, the purchasing power of each dollar decreases due to inflation. This means that even though your payment amount stays the same, it effectively costs less over time in terms of what you can buy with it, as the general price level rises. Therefore, while the absolute cost of living may increase, your home's mortgage burden becomes relatively lighter as inflation erodes the real value of your fixed payments. Now let's look at what happens if interest rates go up too. If inflation is high and banks raise their mortgage rates, say from 5% to 7%, your monthly payment jumps significantly. For the same $400,000 loan over 30 years, a rate of 7% means you'd be paying about $2,691 per month instead of $2,178. When inflation rises and leads to higher interest rates, the cost of mortgage payments increases significantly, making them more challenging to afford compared to what was initially expected. This financial strain often causes many homeowners to consider selling their properties quickly or defaulting on their loans during times of high inflation. But here's the kicker: while inflation makes housing more expensive, it doesn't affect all investments equally. Stocks often outperform inflation over the long term because they represent ownership in companies that can grow and adapt over time. However, your mortgage payment typically stays fixed, meaning its real value decreases as prices elsewhere increase due to inflation. So why does this matter? Because many people underestimate how significantly inflation can erode the purchasing power of their long-term financial plans. You might think saving for a down payment is enough, but if inflation rises sharply before you buy a home, suddenly that savings won't be as valuable in real terms as it was when you started setting money aside. Let's take another look at the numbers. Say you start saving $500 per month to put toward your mortgage. After 5 years with an average annual inflation rate of around 2%, those monthly contributions will have less purchasing power than when you began. Your initial savings would be like trying to fill a leaky bucket. Every bit of water you pour in leaks out just as fast due to the eroding value of money over time. To truly understand the impact, consider this. If you save $500 per month for 5 years at 3% inflation, your total contributions are worth about $25,671 today. But in year 5, that same monthly savings only buys you a little over half of what it did initially, when adjusted for cumulative inflation over the 5-year period. Inflation erodes the value of your money quickly. So how can you protect yourself? The key is to understand the real costs and to plan for them. If you're thinking about buying a home, look at not just today's prices, but also where those prices might be in 5 or 10 years due to inflation. It's important to factor in that higher interest rates typically increase monthly mortgage payments, which can significantly affect your affordability over time. Here's another way to think about it. Imagine you're trying to fill a bathtub with water while someone is slowly lifting the tub out of the sink each month by 2%. The harder you try to fill that tub, the faster it empties. That's what inflation does to your purchasing power and savings. Now let's talk about the hidden math behind all this. Every percentage point increase in interest rates can lead to a significant rise in monthly mortgage payments. If you're expecting stable prices but inflation hits hard, it erodes your purchasing power over time, potentially making your fixed payment feel unaffordable as expenses rise faster than income. This is why many people underestimate their long-term financial needs when buying property due to the impact of unexpected inflation on their budget and cash flow requirements. But here's an important point. While inflation can make housing more expensive, it also has the potential to increase your home's value over time if the real estate market outperforms inflation rates. However, this growth isn't guaranteed and doesn't account for rising maintenance costs or property taxes that often accompany inflation. So what can you do? The best strategy is to build a solid emergency fund first, understand how interest rates and inflation interact, and plan conservatively. Don't just consider current prices, factor in potential future increases due to inflation and economic shifts. Now let's recap. Buying a home with a mortgage exposes you to risks from inflation and rising living costs. While your monthly mortgage payment remains fixed, the cost of other expenses such as food, utilities, and maintenance typically increases over time due to inflation. Understanding these dynamics is crucial for making informed financial decisions. To wrap it up, here are 3 key takeaways. 1. Inflation erodes your purchasing power. The money you save today buys less tomorrow due to higher prices. 2. Interest rates impact affordability. Higher interest rates lead to higher monthly mortgage payments, which can become unmanageable quickly. 3. Plan for long-term costs. Factor in inflation and potential rate hikes when budgeting for a home purchase over the long term. So next time someone tells you that buying a house is a surefire way to build wealth, remember the impact of inflation and rising interest rates on your mortgage costs. It's not just about the initial purchase price, it's also about how these factors can affect your long-term financial situation over time. This is educational and historical, not financial advice. Inflation doesn't just affect your savings, it also eats into your home equity. When you take out a mortgage, you're essentially betting that your home's value will appreciate at a rate faster than inflation reduces its purchasing power. However, this isn't always the case. Historically, during periods of high inflation, homes may struggle to maintain their real value, leaving homeowners with less real wealth than they anticipated. For example, imagine buying a house for $300,000 today with an annual inflation rate of 5%. In just 10 years, that same home might cost $512,000 if prices increase at the same rate every year. If your mortgage is fixed but the price level rises, you may find yourself behind as the value of homes increases faster than your mortgage payments can keep up. This means potentially lower returns on your investment and less equity to tap into when needed. Moreover, inflation can lead to unexpected costs in maintenance and upgrades. As prices rise, so do the costs of repairs, utilities, and even property taxes. These expenses can be a significant burden if not accounted for early on. For instance, a $50 monthly utility bill today might balloon to over $70 within just 5 years at a 3% inflation rate. Another critical factor is the opportunity cost of tying up your money in real estate versus other investments like stocks or bonds. While homes can appreciate over time, they may not keep pace with more liquid assets during periods of rapid economic growth. By locking into a long-term mortgage contract, you're essentially betting against these other investment options that could potentially yield higher returns in different market conditions. Lastly, consider the psychological aspect. Homeownership isn't just an asset, it's also a lifestyle choice with emotional and social implications. High inflation can create financial stress by reducing the purchasing power of income and savings, making it harder to enjoy your home or plan for future expenses like education or retirement. This stress is real and can significantly impact your overall quality of life. So before you consider buying a home, it's important to think carefully about how inflation affects both the initial costs and the long-term expenses associated with homeownership. Understanding these impacts is crucial for making an informed decision that aligns with your financial objectives. This is educational and historical, not financial advice. Inflation can erode the purchasing power of your mortgage payments over time. For example, if you take out a 30-year fixed-rate mortgage today and inflation averages around 2%, by the end of that period, each dollar you pay in principal and interest will represent less buying power due to rising prices. This means the real cost of your monthly payments decreases relative to the general price level, but the nominal amount remains constant. Moreover, consider how inflation affects your home's value. During periods of high inflation, house prices often rise rapidly. If you're planning to sell in a few years, this could work to your advantage if you can afford to ride out the fluctuations without needing to tap into equity or refinance at unfavorable terms due to higher interest rates. However, if you're looking for long-term stability and plan to stay put, sudden spikes in inflation could lead to unexpected challenges like property taxes increasing faster than anticipated. Another critical factor is the impact of inflation on your salary's purchasing power. If you're counting on steady salary growth to keep up with rising costs, including mortgage payments, high inflation can outpace wage increases. This disparity means less disposable income for other expenses and savings goals. For instance, if the cost of living or rent rises faster than your wages, it may strain your finances even if your nominal income remains constant. Lastly, keep an eye on interest rates. Inflation typically leads to higher interest rates as central banks try to cool down the economy by making loans more expensive. Higher mortgage rates can significantly impact monthly payments and affect affordability. For example, a 1% increase in mortgage rates could add several $100s to your monthly payment, depending on the size of the loan, thereby affecting your budget constraints. So before committing to a mortgage, it's essential to consider various factors holistically. Understanding the full picture can help you make a more informed decision about whether now is the right time to buy, and how inflation might affect your financial situation in the coming years. This is educational and historical, not financial advice.